Welcome to the exciting world of stock market investing and dividends. If you've ever wondered how to make your money work for you, grow your wealth over time, or even create a stream of passive income, you're in the right place. In this video, we're diving deep into the essentials of stock market investing with a special focus on dividends, a beginner-friendly way to start building your financial future. We'll cover what the stock market is, how it works, and why it's accessible to everyday people like you. Then, we'll zoom in on dividends, what they are, why companies pay them, and how they can become a powerful tool in your investment strategy. We'll also walk you through practical steps to start investing, from choosing a brokerage account to picking your first dividend-paying stocks. Along the way, we'll debunk common myths, share tips to avoid beginner mistakes, and explain how to balance risk and reward. Whether you're starting with $100 or $10,000, this video is packed with actionable insights to help you take your first steps with confidence. Stick around. This could be the start of your journey to financial freedom. Welcome to the Trade Savvy Academy, and don't forget to subscribe for weekly wealth building tips. The stock market is your gateway to wealth building. So, let's kick things off with the stock market. Picture it as a giant marketplace where people buy and sell pieces of companies, called stocks or shares. When you buy a stock, you're buying a tiny slice of that company, whether it's Apple, Coca-Cola, or a lesser-known business. The stock market is where these transactions happen, and it's not just for Wall Street tycoons. It's for anyone with a few bucks and a desire to grow their wealth. The beauty of the stock market is its potential for growth. Over time, stocks have historically provided higher returns than savings accounts or bonds, with the S&P 500, an index of 500 major U.S. companies, averaging about 7 to 10% annual returns after inflation over the long term. But here's the catch: the stock market can be a roller coaster. Prices go up and down daily based on economic news, company performance, or even global events. For beginners, this volatility can feel intimidating, but it's also what creates opportunities to buy low and sell high, or, as we'll discuss, to earn steady income through dividends. Understanding the market's ups and downs is the first step to investing wisely. What are dividends, and why do they matter? Now, let's talk about the star of the show, dividends. A dividend is a payment that some companies make to their shareholders, usually in cash, as a way of sharing their profits. Think of it like a thank you note for owning their stock. Not all companies pay dividends, but those that do, often stable, well-established businesses like Procter & Gamble or Johnson & Johnson, tend to do so regularly, typically every quarter. For example, if a company pays a $1 annual dividend per share and you own 100 shares, you'd get $100 a year, often paid out as $25 every 3 months. Why does this matter? Dividends give you passive income. You don't have to sell your shares to make money. Plus, they can be reinvested to buy more shares, which compounds your wealth over time. For beginners, dividends are a fantastic way to dip your toes into investing because they provide tangible returns while you learn the ropes. They're like training wheels for your investment journey. How do companies decide to pay dividends? You might be wondering, why do some companies pay dividends while others don't? It comes down to a company's goals and life stage. Mature, profitable companies with steady cash flows, like utilities or consumer goods giants, often pay dividends because they don't need to reinvest all their profits into growth. They've already built their empires and want to reward shareholders. On the other hand, younger companies like tech startups often reinvest everything to fuel expansion, so they rarely pay dividends. When a company decides to pay a dividend, its board of directors sets the amount based on profits, future plans, and financial health. They might pay a fixed amount per share or a percentage of earnings, called the dividend payout ratio. For example, a company earning $2 per share might pay 50 cents as a dividend, keeping the rest for growth or debt repayment. As a beginner, look for companies with a history of consistent or growing dividends, often called dividend aristocrats. These are businesses that have raised dividends for at least 25 consecutive years. They're a safer bet for steady income. The power of dividend reinvestment. One of the most exciting parts of dividend investing is reinvestment, which can supercharge your returns over time. Here's how it works. Instead of pocketing your dividend payments, You use them to buy more shares of the same stock. Those new shares then generate their own dividends, which buy even more shares, creating a snowball effect. This is called compounding, and it's like planting a tree that grows bigger every year. For example, let's say you invest $1,000 in a stock with a 4% dividend yield, paying $40 a year. If you reinvest those dividends and the stock grows at an average of 7% annually, your $1,000 could grow to over $2,900 in 20 years, without adding another penny. Many brokerage accounts offer automatic dividend reinvestment plans, DRIPs, making this process seamless. For beginners, reinvesting dividends is a low-effort way to build wealth, especially if you're in it for the long haul. The earlier you start, the bigger your snowball grows. Getting started. Setting up your investment account. Ready to jump in? The first step is opening a brokerage account, which is like a bank account for buying and selling stocks. There are tons of beginner-friendly platforms out there, like Fidelity, Vanguard, Charles Schwab, or even commission-free apps like Robinhood and Webull. When choosing a broker, look for low or no fees, an easy-to-use interface, and access to research tools. You'll need to deposit some money. Don't worry. You can start with as little as $100 on many platforms. Once your account is funded, you're ready to buy stocks. Most brokers let you search for companies by their ticker symbol, like AAPL for Apple, and place a market order to buy at the current price. If you're nervous about picking individual stocks, consider exchange-traded funds, ETFs, like the Vanguard Dividend Appreciation ETF, VIG, which hold a basket of dividend-paying companies. ETFs spread your risk across many stocks, making them a great starting point for beginners. How to choose dividend stocks? Picking the right dividend stocks is where the fun begins, but it requires some homework. Start by looking for companies with a strong track record of paying and increasing dividends. Check the dividend yield, which is the annual dividend divided by the stock price, expressed as a percentage. For example, a $100 stock paying $3 a year has a 3% yield. But don't chase high yields blindly. Yields above 6 to 8% can signal trouble, like a struggling company whose stock price has tanked. Instead, focus on quality. Look at the company's financial health. Are they profitable? Do they have manageable debt? Websites like Yahoo Finance or Morningstar can show you metrics like earnings per share and debt-to-equity ratios. Also, consider the payout ratio. Dividends should ideally be less than 60 to 70% of earnings to ensure sustainability. Diversify across industries like healthcare, consumer staples, and utilities to reduce risk. A beginner-friendly pick might be a company like Coca-Cola, KO, with a reliable dividend and global brand. Take your time and don't rush. Good stocks are worth researching. Understanding risk and managing expectations. Investing isn't a get-rich-quick scheme, and it comes with risks. Stock prices can drop due to market crashes, economic downturns, or company-specific issues. Even dividend stocks aren't immune. Companies can cut or suspend dividends if profits dry up, as some did during the 2008 financial crisis or the 2020 pandemic. To manage risk, diversify your portfolio by owning stocks in different sectors. Don't put all your money into one company, no matter how safe it seems. Also, set realistic expectations. The stock market's long-term average return of 7 to 10% isn't guaranteed, and you'll likely see years with losses. Dividends can cushion those dips, but they're not foolproof. A good rule of thumb is to only invest money you won't need for at least 5 to 10 years. If you're nervous, start small and practice with a paper trading account, where you invest fake money to test your strategy. Patience and discipline are your best friends in the stock market. Common beginner. Mistakes to avoid. Let's talk about some pitfalls to steer clear of. First, don't invest based on hype or hot tips from social media. Do your own research. Second, avoid timing the market. Nobody can predict when stocks will rise or fall, so focus on long-term goals instead of day-to-day price swings. Third, don't ignore fees. Even small trading or management fees can eat into your returns over time, so choose low-cost brokers and funds. Fourth, don't chase high dividend yields without checking the company's health. A juicy 10% yield might mean the stock is a ticking time bomb. Finally, don't let emotions drive your decisions. Panic selling during a market dip or buying during a frenzy can derail your strategy. Stick to a plan, whether it's investing a fixed amount monthly or reinvesting dividends consistently. Learning from these mistakes early will save you headaches down the road. Building a long-term dividend strategy. So, how do you turn dividend investing into a long-term wealth-building machine? Start by setting clear goals. Are you aiming for passive income to cover expenses, or are you building a nest egg for retirement? Your goals will shape how much you invest and which stocks you choose. Next, commit to regular investing. Even $50 a month adds up over time. Use dollar-cost averaging, where you invest a fixed amount regularly, regardless of market conditions. This reduces the risk of buying at a peak. Reinvest your dividends to maximize compounding, but as you near your goals, you might switch to taking dividends as cash for income. Periodically review your portfolio to ensure your stocks are still performing well. But don't over-tweak. Investing is a marathon, not a sprint. If you're young, you have time on your side, so even small investments now can grow into substantial sums. For example, $200 a month invested at 8% could grow to over $500,000 in 40 years. Stay consistent and let time do the heavy lifting. Tax implications of dividends. Before we wrap up, let's touch on taxes, because nobody likes surprises at tax time. Dividends are taxed as income, but the rate depends on whether they're qualified or ordinary. Qualified dividends from most U.S. companies held for at least 60 days are taxed at lower capital gains rates, 0%, 15%, or 20% depending on your income. Ordinary dividends, like those from real estate investment trusts, REITs, are taxed at your regular income tax rate. If you're investing in a taxable brokerage account, you'll get a 1099-DIV form each year detailing your dividends. To minimize taxes, consider holding dividend stocks in tax-advantaged accounts like an IRA or 401k, where dividends can grow tax-free or tax-deferred. Talk to a tax professional to optimize your strategy, especially if you're earning significant dividend income. Understanding taxes upfront helps you keep more of your hard-earned returns. Congratulations! You've just taken a crash course in dividends and stock market investing. We've covered the basics of how the stock market works, why dividends are a beginner's best friend, and how to start building a portfolio that grows over time. You've learned how to choose quality dividend stocks, reinvest for compounding, and avoid common mistakes. Most importantly, you've seen that investing isn't just for the wealthy, it's for anyone willing to learn and stay patient. Your next steps are simple. Open a brokerage account, start researching a few dividend-paying stocks or ETFs, and invest a small amount to get your feet wet. Don't wait for the perfect time to start. The best time is now. With every dollar you invest, you're planting a seed for your financial future. So, what are you waiting for? Hit that subscribe button for more investing tips, and let's grow your wealth together.